Good night, everybody. Welcome to another episode of the All Over It podcast. Today, September 29th, 2025. Today is episode 22 of this podcast. Oh, we growing. God bless, The devil is a busy man, but we can always overcome. We can always conquer him. Conquering lion spirit. Yeah. Lion wolf mentality. Yeah. We can keep that. But yeah, blessings, my family. Welcome back to another episode. First thing first, thank you. Thank you for joining. We growing. Like I say every week, I seen the growth. I seen new people, I seen returning people telling me, yeah, I like what you do there. I like what you say. I tell a friend, nope, I ain't even gotta say it. I gotta big up my friends in the chat. My boy Rodell in the chat. Okay, good. I know you would have tuned in for sure. Yeah, I know this one a good one for you. Yeah. My boy David, I tell you we certified now. Good. Just in case you forget. But yeah, all I could do every week is thank you. Thank you for coming on. Thank you for joining, subscribing. Like I always say, continue to like, subscribe, comment, continue showing support. Trust me, love alone. I appreciate the love. And without you, there'll be no podcast. So yeah, I wouldn't be here today. So love alone. As you know, I am on this journey to get this YouTube channel to 1,000 subscribers. So tell a friend to tell a friend to tell somebody who might be their friend, like, subscribe, comment, share, all that good YouTube stuff. But yeah, you don't know. Love alone to my dogs them. Yeah, that's bless. I love that. But yeah, as you know, anybody who is returning, anybody new, you want to get shout out, leave a comment and I will shout you out. And today is the last episode of this financial literacy series that we've been on. I know. Checking like, where has the time gone? But just know all the episodes still available. If you want to see them, go to the YouTube. All the financial literacy episodes there, all the episodes from episode 1 straight up to 22 and moving forward. Find everything in you. But yeah, today we here to talk about life insurance. Securing your future using life insurance. Today we can talk about the truths, the myths, we can burst myths, all these things we're going to do here today. But trust and believe, we have a good interview in store for you. You see, I appreciate it. My boy tell me great financial series. I appreciate the support. Love alone. I don't know. Like I say, we elevating, we growing, we doing things. And I glad all of you here along for the ride. Real talk. So yeah, today I have a great interview in store. I ain't even gonna waste no time. Normally I do a motivational message, but today again, the whole episode gonna be the motivation for you. So I don't have to give you a motivational message. When you see and hear what is going to be delivered today, you're going to feel motivated and empowered and inspired to get up and go out and make something happen. And that's my mission. Good evening, DTM Maria. I feel so warm-hearted DTM Maria take the time out to come on my podcast on her birthday. Please, are you help me wish DTM Maria Eduardo happy birthday. Love. I appreciate the support, really and truly. You did not have to be on. You could have been somewhere living life, enjoying your birthday, but you chose to be here. That's love. So yeah, I ain't even gonna waste your time. I can get right into it. I have to introduce these two people with the great introductions that they deserve, because trust and believe it's going to be a great episode. You see, look, DTM Maria, look, you get one of my viewers wish you happy birthday. That's one on the list. Okay, good. But yeah, diving right into it. Today, I will be interviewing Clem and Shenita Edwards, the owners of Vanguard of Wealth. Today, I feel so honored to be able to deliver this to you. So I hope you appreciate it, and I hope it's well received, just like how I trying to bring it across. You see, even Gina say, looking forward to this. Good. So yeah, Clem Edwards, founder of Vanguard of Wealth, is a dominant force in financial security and personal growth. With a relentless drive to help families and entrepreneurs build generational wealth, Clem combines life insurance expertise with a personal commitment to identity, leadership, and resilience. Whether he's mentoring leading educational workshops, or breaking down complex financial strategies into actionable steps, Clem brings clarity and energy to every conversation. His signature lion wolf mentality, I love that one, for personal development inspires clients and colleagues alike to wake, win, and repeat. At Vanguard of Wealth, Clem is dedicated to empowering you to take control of your financial future and lead your life with purpose and confidence. Great. Shenita Edwards, co-founder of Vanguard of Wealth, is a dynamic leader with a passion for empowering women and entrepreneurs to secure their financial futures. With years of experience in life insurance and annuity solutions, Shenita combines professional expertise with a deep personal understanding of the unique challenges faced by today's families. Shanita's approach yet confident Shanita's approachable yet confident style makes her a trusted consultant and mentor, providing her clients with personalized strategies for building wealth and leaving a lasting legacy. As co-leader of Vanguard of Wealth, she's committed to creating a community where financial literacy is not just a goal, but but a lifestyle. Shanita's mission is to help you break free from uncertainty and step boldly into your financial power. So please help me welcome interviewers. Welcome, welcome, welcome.
Hello.
Hello, how you doing, Oliver?
I am well, and trust and believe you have some great responses in the chat. I don't know if you guys could see the chat on your side, but it's trust me, people are excited for this one. So I feel positive. I think you feel positive, and yeah, you see, yeah. Lion wolf mentality, love it,
All right.
love it. So yeah, I gave an introduction, but you guys could also share with us, introduce yourselves, give a short bio, and let me get right into it.
Well, first and foremost, thank you so much, Oliver, for inviting us onto your podcast today and your platform and allowing us to speak to your audience and share this vital information because we're passionate about it. We can tell that you're definitely passionate about what you do, and so that's what it takes. And we're looking to be able to share as much as we can.
Amen. Amen to that.
Yes. Thank you as well, Shanita, my wife. Of course, my better half has said everything, but yes, we thank you and we appreciate you. It's just getting the word out and helping as many people as we can. So we appreciate you.
Well, yeah, I thank you for being on too. And yes, for the people. So it's for all of us. So
Yes.
yeah, let's get right into it. Let's uncover it all. And you guys provided me with some slides. So what we're going to do, viewers, we're going to start with the slideshow. Clem and Shenita will provide us some information about life insurance. And if you guys have any questions, just feel free to drop them in the chat. And then after the slideshow, we'll get to the question section, which I also have some questions. So trust and believe, we got a good one here in store. So I'll dive right into it. I'll bring up the slideshow. Right now, let me share my screen. We got it right here.
Okay, so real quick, we're a part of LMT Financial, who is a partner of Integrity, and Integrity is the largest privately owned insurance company in the country. So you can go to the next
in the
slide.
US.
In the US, yes.
That's what I'm specifying.
Here, it just gives you a little bit of background about Integrity. We got started back in 2006, but presently we are a $20 billion privately held financial marketing organization, or FMO, with more than 500,000 independent agents and advisors on our staff. And just to know how big we are, when you think about Integrity, think about some of your favorite name brands that you hear about all the time, from Ralph Lauren, Papa John's, Nordstrom, Levi's. If you think about, if you're a football fan, the NFL or the MLB, some of the largest franchises, the Dallas Cowboys, San Francisco 49ers. We even have Steve Young, the former quarterback for the 49ers, as the chairman of our board. It just really speaks volumes to, how strong and reputable, our company is when it comes to being able to have a presence in the financial industry, the financial market industries.
I just want to point out the Ralph Lauren, like you said, that's one of a brand that I actually am wearing currently.
We see you, okay.
Just wanted to say, and yeah, I got a big up Harley Davidson one time. Have to, we use bikers. But I just want to show this too. Just want to say thank you to my boy Saido, all the way from Africa.
Oh, wow.
Nice.
Who will join in, who
Thank
said, wow, it's so huge. You see? he checking, like, look how big Integrity is. But yeah, I just want to point out and move forward.
Yes.
And in addition to that, the company that we keep, when we're working with these carriers, basically Clem and I are independent life insurance agents, meaning we're not captive, unlike certain other agencies. We are able to shop around, because when it comes to life insurance, people have different needs, they have different wants, they have different concerns. And so we need to be able to shop around so that we can find the right product for you specifically. So we can shop with multiple carriers. We actually have access to more than close to 450 different insurance carriers on our platform. These are just a handful of who they are. These carriers that are listed here, these are all AAA rated carriers that have been around for many, many years. And just to give you an example, National Life Group, they're celebrating 178 years. North American, they were one of the very first carriers that signed on with us. Foresters, they're celebrating 151 years this year. American National, guys, believe it or not, if you know the story of Bonnie and Clyde, the outlaws here in the U.S., they actually wrote the death benefit or the life insurance policy for Bonnie and Clyde. So thanks to them, now we have to do risk assessments on everybody.
Wow, that's real longevity, I just have to say. And I like that you say that because you guys have all these different connections, you're able to like kind of shop around and get what's best for the client specifically. Because yeah, it's not like a cookie cutter, one size fits all type of situation. Is your depending on your situation is how
Yes.
you
Everyone
would
is
move
different.
forward and set up yourself. I feel you. I just want to show this again, Saido. You see, tell you I'm watching all the way from Gambia, West Africa.
All
Wow,
right.
respect.
Yeah.
Thank you.
And then Rodell, come on, he say, yeah, one stop shop like Amazon.
Respect Amazon, yeah.
Hey, we're going to find you the best coverage. We got to make sure we do our due diligence, right? Because everybody has, different health concerns. And if they do, then we need to know who can best cover them. And so that this just allows us to find the best carrier that will be able to offer them coverage.
Yep. And totally understood. And I just want to point out the fact that basically what you guys are saying here is that you are an agent within the integrity company framework, that now you have access to all these companies, as you say, the company we keep, that you could provide these services to your clients.
Correct.
That's great. So I'll move forward.
Okay, so Oliver, let me ask you, what have you heard of the 4 quadrants of wealth?
Kind of, not so familiar.
All right, let's refresh. Let's talk about it. So when it comes to money, the first thing you want to have is cash, right? It's liquid, it's safe. You can put it in the bank, you can put it under your mattress, in the wall, wherever. You have access to it whenever you need it, right? Next thing people get into is some form of stocks, whether on the corporate side, you're dealing with 401ks, IRAs, or you may be dabbling in some day trading, things of that nature. So when the market's doing well, you've got some returns coming in, right? When the market's doing bad, you're losing money, but not knocking it. Everybody needs to get into some form of trading if they can, right? So next thing people want to get into is real estate. So they get a house, they rent it out, or maybe they do an Airbnb. They have income coming in, and also they're able to get tax breaks. But Oliver, let me ask you, let's say you have $80,000 in cash, right? It's there. You don't need to touch it, but it's there if you need it, right? You're dabbling in some stock here and there. You got money coming in from there. You're losing a little bit, but just like we talked about early last week, what happened to the market?
Yeah, it was bloody September.
Right, but it didn't hurt. Maybe it didn't hurt as much because you had $80,000 in cash savings, right? You got a house. You're doing an Airbnb. You got income coming in from that. You got tax breaks. But what is the one thing, other than you dying, other than death, that could tear all this down? What do you think that is?
Probably health. Maybe if you get sick, then you gotta spend all your money on health care.
Correct. Good job.
You hit right on the head.
Right. So yeah, if something were to happen to you, heart attack, stroke, cancer, or anything of that nature, you're unable to work. Now you've got your bills. If you have a business, you have your bills and you have your business bills. Now you got your hospital bills. Maybe you need something to be taken care of. You ever heard of long-term care?
Yeah, that's like when you get care when you reach to senior age, right?
Senior age, yeah, but it could be sooner than that. You never know what could happen. You could be healthy 1 minute and something happens. God forbid something happens, and now you're stuck in a situation. But And these are just some statistics that we have here on the side. Oliver, if you want to click those, where you got, between 18 and 64, a 40% chance of needing long-term care. Between 18 and 64, right? And of course, as you get older, that percentage goes up.
Tremendously.
But as far as long-term care, annually, you're looking at somewhere between 100 and between 117 to $120,000 annually, out of pocket. In Florida, it's 120. So
it's imagine that might be double.
Right. So if something like that were to happen to you, there goes your cash, there goes your stocks. You're gonna have to sell that house. But there's one thing that's liquid and safe like cash, has the ups of the market, none of the downs, and you're able to get some form of income and also tax breaks, and that's life insurance. Life insurance, that's what we focus on, life insurance annuities. Pretty much what we do is we secure all your assets. That's what we do. We're the security.
And I like that because not my last week's episode, but the episode prior to that was on asset protection, because in this financial literacy series, my approach was, okay, we have all these different avenues that we could make money. Okay, now we gotta see how we could protect it. You went out, you gather all these assets, you make all this money. Now how you gonna keep it? You gotta protect it too. So I like that you said that. A form of protection.
Yeah, you think about sports. Sports has offense and it has defense. We have a defensive strategy when it comes to it. Just like Clem said, we want to make sure that you're not losing. Everybody says, how much can how much can I make? It's not just how much can you make. Like you said, it's how much can you keep. And so that's our focus. And we want to make sure everybody understands that.
Yes, because we don't know when, like, as you see right here, you don't know when something's going to happen in life. You could be completely healthy one day and something happens the next. What just popped in my mind, and I may be going a little bit back and telling my age, but Christopher Reeve, my first Superman, he was Superman, right? He was healthy, tall, and he horse riding accident, and boom, can't walk, can barely speak. He's confined to a chair, and things like that can happen just like that. And if you're not prepared, everything that you have could come crashing down.
Like they say, prevention is better than cure. Before we move on, I just want to show this comment from Saido. I can't imagine life without insurance. Imagine that.
Yeah, he must know a little bit what we know, which we'll get into that in a little bit.
But yeah, so moving on. So yeah, I like this.
We also like to talk about building a financial home. A lot of individuals, they with this slide, what I like to talk about is how to build a financial home. But a lot of questions come about from individuals that'll say, well, why do the rich keep getting richer, or why do the wealthy keep, getting wealthy while the poor keeps getting poor? Well, we can tie it all down here with this, because we're going to talk to you about what the top 1% to 5% do versus the rest of Americans. Okay, so the wealthy, when they start out, they always start out with a foundation of life insurance, right? And with life insurance, with that, they not only do they have a death benefit, that can create instant wealth, or it could be wealth that can be created later on, right? So they have that death benefit. They also have what we call a living benefit. Now, the living benefit, this is something that you have access to in certain insurance policies. The living benefit, if I could just give you an example, right? A living benefit would be, again, if you have cancer, heart attack, stroke, a serious severe illness or injury, you can actually tap into the death benefit of your policy and leverage that money, access that money, use it to help pay for your long-term care needs and treatment. So, for example, if you let's think about a lady that works in our office. She actually started out as a client, and she put a policy in place for herself. And within 6 months of having that policy placed, she was diagnosed with lymphoma, right? And so now she's a mother of two and a wife, and she helps to provide and take care of the family uh, through working right outside of the home. So now she's not able to work. There's days when she doesn't feel good enough, strong enough to get out of the bed, to take care of the family, and she can't work, right? So now that she put this life insurance policy in place, we were actually able to file a claim on her behalf and help her have access to the death benefit while she's living. So the carrier, they approved her claim and they cut her a check for $250,000 and directly deposited that money into her bank account, tax free, and she never has to pay that back. She was able not only to just use that money to pay for her treatments, the chemo, the radiation, but she's also able to help pay all her medical bills. Because yes, you may have health insurance, but health insurance does not cover that long-term care. It does not cover, that additional, need for the treatments and things like that. So, and not only that, she could use that money to do whatever she wanted with it. So now she's able to still contribute to the monthly household, and pay for those bills, still take care of her family, and be that support, alongside her husband, just as though nothing had happened. So no, it doesn't take the illness away, but it does make that financial burden not so much of a burden because you have those funds there, right? So that's the living benefit. And then there's a tax advantage cash that comes along with these plans. And so that's their foundation. Then next, they have cash on hand that they can have, and so, or that they have in place. And so with their cash, they're able to do whatever they need. And then they look at, okay, well, now we can get a house. We'll go ahead and add on some real estate and, get into our home. And then if they get around to it, if they need some tax breaks, then they'll tap into the 401ks and IRAs and those things. Now, check out how we do it on the other side. We're told go to school, get good grades, and get a good job so that we can get benefits, right? With our benefits, we get our 401k, we good. We got our 401k, I'm good. Then okay, now I got my 401k, let's get a house. Let's start this family thing going, right? So now we got our house. Now we'll say, okay, well, we got our house. Let's go ahead and just kind of start putting some savings away. Let's make sure we got something in the, in our account. So we have our cash. And then if we get around to it, we might add some life insurance, right? But think about this. If the stock market was to take a hit, right, that money's gone, right? Because just because the market recovers doesn't mean that your account's going to recover. Let's say you have $100,000 in your 401k and the market takes a hit 50%, right? That's a 50% loss. So now you're at $50,000. But let's say it goes up by 50%. What number do you think that brought you back up to? A lot of people would say it would be 100,000. It only went up by 50%. So 25,000. So you still are at a $25,000 deficit, right? So if the market takes a hit, it's done. Real estate takes a hit, right? And we saw that back in 2008, 2009. People lost homes. They lost a lot of money in real estate, right? So if that takes a hit on our side, we are completely done, right? Our foundation is gone. But if you look at the top 5% here, let's say the 401k, the market takes a hit, real estate takes a hit, they are still good. They still have a strong foundation of cash, life insurance, all of those things that they can tap into. And they're going to use that money. They're prepared and ready to be able to buy up the real estate that we had to release. They're ready to buy up the stocks that we aren't able to keep because we had to sell them, but they know the strategy. You buy low, sell high. And so they have access and they're prepared they have the resources to grab all of that. The wealthy will continue to get wealthy because they understand the flow of money. Money is called what? Currency. It's always moving. And so you want to make sure you understand the flow, the current of currency.
Into that. I like that. And And we already have questions in the chat, but like I can bring it up, but I think we should answer this one after. But what do you think? The question is, can a person who has health issues get life insurance?
So, yes, it just really depends. I'll say it depends on the type of health issues that they have. And so that's why we sit personally with everyone. And before I'll even write an application for life insurance, I want to ask questions about what type of health issues. So, for example, when we say we work with multiple different carriers, we have carriers that will say, well, they're not a proponent for individuals that have diabetes, right? And so I know that I can't work with that one carrier, but I do have two other carriers that I can work with and help get them coverage. And I'll just give you an example. My mother, she's a cancer survivor. She has multiple sclerosis. She had a mild heart attack, and I'm thinking, there's no way I can get her coverage, right? I was able to find coverage because I'm able to work with different carriers. Well, some carriers turned us down. There's other carriers that said, yes, we can do that. So it just truly depends. A lot of people think, hey, I'm a cancer survivor, I can't get covered. No, that's not the case. You can still find coverage. So it truly just depends. There may be some health issues that we might not be able to cover, and if not, then I'm going to do my best to refer you out to someone that possibly can. But for the most part, we're going to do our part to shop around and find the best coverage for you before we write that application.
I like that. I like that. Like Rodell say, one stop shop. Amazon.
I like it. I like it.
No,
Hey,
but I
Oliver,
like that
I
too.
just want to say, just remember that my wife just said that she loves Amazon. I just want to put that down there because I get a lot
Well,
of pack.
maybe we gotta
I need
maybe
to.
we gotta call maybe we gotta call them up, see if we could get some endorsements. Tell them we marketing
Yes.
the platform. But I like that too that you said that and gave me, I guess, a little hope too, because even with my situation right now, like my dad's in the hospital, and it's roller coaster. Like these days been good, but some days does be down. And like you say about your mom had heart attack, my dad actually passed through 4 heart attacks. He have IED machine, and so in a situation like for him, I would think like, bye. I don't think it's even possible, but you never know. Maybe you gotta try. And I would say that's what I would take from what you just say. You never know until you try. You gotta shop around and really see what's available to you before you just count yourself out. But
Yes.
Correct.
Yes.
Correct.
me, let me move forward.
So when it comes to life insurance, we talk about what the
Yes,
new
you
life insurance is. When it comes to life insurance, before we even jump into it, Oliver, let me ask you, when it comes to life insurance, what do you know about it? Why do people typically get it?
So I could say I know for sure most people look at life insurance as benefits only in the case of like death or a passing. But I could say I know a little more than that because when I was in the US, I did have a life insurance policy that had, like you mentioned just now, both, well, death benefits, life benefits, and also a cash value added. You
Okay.
see, look, even my boy Joe, big up my boy Joe one time, say, yeah, for mortgages normally. And that's a good answer because I actually had a conversation with a banker that I know yesterday. And as he mentioned, exactly like he said, like Joe said, here in St. Martin, usually when you go get a mortgage, they usually require you to go get life insurance as well. But that's like a term, not a
Mhm.
different.
Okay.
But it was told to me that there is other entities that do have other options. So there is options here in St. Martin as well, but probably not as good as those.
All
But
right.
I'll save my personal story for the end, but I know a little bit. And yeah, even Rodell say, for when you're
When you dead,
dead,
that's what most people say.
you
Yeah.
see, family get
God,
money.
somebody gets money.
When you're dead, family
Yep.
get money.
Yeah.
Yep.
I
That's
like how we put it like back to back too.
so
So okay, so I don't say it's different in my own case. My dad is diabetic since
Mhm.
2019 to date, and all medical bills are on me. No
Mhm.
insurance. We are facing things differently. So unfortunately, I know how that goes because right now that's how it is for me. My father going through his issues, and we have healthcare from the local healthcare services, but like how you talk about long-term care, and that we say having a life insurance that you could tap into to save you with certain of these bills that going to acquire for sure.
mhm.
We even me don't have it like outside of say. So I understand you, my brother. I know the struggle.
Yes, yeah. And so life insurance is no longer just about, hey, if I die, you know, that my family's going to get that
Nah,
money. It's no
family
longer
members,
just
no.
about being able to pay, the mortgage or have uh, uh, money left over for the kids. You can access it now while living. And because if you didn't know that before, now you know, and now that we know better, we do better. So if you didn't know these things before, now you can look at putting something in place so that you can have these coverages for when you need them in the future. But when it comes to life insurance, there are two different types, no matter where you go in the industry to get it. And so we're going to talk about those two different ones. The very first one being what we call term. Okay. Now, when you think about term, I want you to think about temporary coverage. I want you to think about coverage that terminates. Okay. And so the easiest way for me to explain it is we're going to look at the details that Oliver's bringing up on the screen right now. So when you think about term, you think a term period of time, it can be 10 years, 15, 20, 25, 30. Some companies even go up to 35 years, right? And so the easiest way that we can explain it is, let's say we have a 34-year-old female, and let's say she has, we're going to look at a time frame from 34 to age 64, right? And let's say she has a $500,000 of coverage in place, right? And she's paying about $50 a month. We know that if something happens to her between the ages of 34 and 64, if she passes away, God forbid, that 500,000 is going to pay out to her beneficiary. Okay. But let me ask you, what do you think happens the moment she turns 65 and she outlives that policy? What do you think happens to it? You think it's going to,
Well, hopefully she could like refinance, like how you refinance a market.
okay, okay. So you think that she could possibly renew it or extend it?
Yeah.
Okay. She can, but do you think she's still going to be paying about $50 a month for that coverage?
No, for sure not.
Yeah, absolutely not. Guys, the cost of insurance depends on two things, your age and your health. Okay. So the older you are, the more expensive it is. The younger you are, the more affordable it is. That's just how it is. So the best time to get life insurance is when you're younger because you can lock in a rate now that'll cover you for the next 30 years. Right. But a lot of us, we think of life insurance as an older person's problem. We don't need it until we get older, but that's the time it's going to cost you the most. Right. And so now we know that, okay, let's say she's 65 and she wants to get coverage, but she sees that, man, if I want to renew this, it's gonna be, I've seen those amounts jump up to 200, 300. There's just amounts that now that you're 65, you're retired, you're on a fixed income, you can't do that. I have an uncle, he had a term policy with a company that's very popular for selling term, and he had coverage. And so he remarried, and he and his new wife were looking through his insurance and her insurance, and he realized, hey, my policy is going to expire in 7 years. And he said, well, if it expires, maybe I can just renew it. So they thumbed through the policy just to see, well, what did that look like for him? And he was paying about $79 a month presently for that coverage. Well, at the end of that 7 year, his premium was going to go up to $719 a month. And he said, "Oh,
10 times.
there's no way I can do this." And I'm like, I wouldn't even want to do that, you know? So he called me and I was able to help him find a permanent plan and lock in a rate for the rest of his life where he's not having to worry about the cost of that coverage going up, right? So there's nothing wrong with term, guys. It's very affordable. Yeah, you're supposed to get a lot of it because of its affordability. The rule of thumb is for every $50,000 of income that you make, you should have $1 million of coverage because because they make terms so affordable. The downside is that 98% of the time it's going to expire. Okay, so it shouldn't be the only coverage, especially if you're looking at being able to pass on a legacy, leave a legacy. It should not be the only coverage that you have. But if that's where you have to start out, then there's nothing wrong with it, right? Now, the majority
Uh,
of people have term. Go ahead.
I just wanted to say before we continue, I just wanted to bring up this comment that was posed in the chat by my brother Shelly. Big up Shelly one time, you don't know. So like how you were saying about what we think would happen in the event the female reached 65, as Shelly says, she'll either collect or continue. I want you to respond to this. But he also have another comment I want to bring up. I want you to respond to this one.
Okay. Shelly, that's a great question, right? So will she be able to collect or continue? So with term insurance, when it expires, it's done. It's gone. The coverage is gone, and all the money that you've paid into this plan, it's done. It's like you're
So you're
renting.
saying, so you're saying basically, even if, let me say, she reached 64, even though she been paying that money every month, there's no chance that they're gonna say, okay, well, look, this is your 500,000.
No.
No, it's like you're renting coverage. You're paying them to hold that money to the side for you. If something happens, that'll pay out to your family.
So if you think term, when you think term, you want to think terminate. Okay. Now there are other options. There's a certain type of term where it's similar to this, right? But once the female turns 65, all the money that she's been putting in, all the premium that she's been putting in every month, she gets all that back.
The coverage is gone.
The coverage is gone, but she's
Okay.
able to get all that premium back that she's been paying every month for 30 years. That's a different
Okay.
type of term. It costs a little bit more, and you have to qualify for it.
Yeah, we call that
Really got
return
a
of
lot of
premium.
options.
Yeah, return of premium.
Really got a lot of options. A lot of options. I just want to point out too that for my Martin viewers, Shelly also mentioned that Compass Insurance Company does have a life insurance with a saving attached and more. So,
Okay.
like I said, there are options. Nagico has life insurance plans as not just term, so they have other options as well. But yeah, you gotta shop around, see what works best for you, no matter where you be. And yeah, I done blessings. Just want to say that. You was going to say?
No, I was going to say also with the term. So with most terms, what you'll find is living benefits are not attached, right? With most term, but with our term, we do offer living benefits. So, like we said before, heart attack, stroke, cancer, anything of that nature happens, you're able to use your life insurance to pay for those hospital bills and everything like that. So, I do want to say that.
Okay. I just have to show this one from Rodell again too. Rodell say, when food expires, you don't eat it after, you throw it away.
Right. It's gone. It's gone. You don't have it. You don't want it. You don't want it. Right. But term, again, I want to just stress nothing wrong with term, guys. We have term. as in addition to other coverages. So there's nothing wrong with it. It just, again, should not be the only coverage you have. Most people say, hey, I have coverage through my job, I'm good. But you have to think, if you get fired, if you get let go, if you get laid off, even when you retire, you no longer have that coverage, because 9 times out of 10, you can't take that coverage with you. And if you do, that group rate that you're paying at your job, now you have that full on payment. And so, and the coverage at your job does not come with those living benefits, guys. And think about it. If you have a heart attack, cancer, stroke, any major, health event at, while you're working, they're going to give you typically, here, they're going to give you 3 months max where they'll protect your job. But after that, you're on your own, right? And so, what if you had a life insurance policy that had those living benefits, and you experienced that health event? Now you're not stressed about, hey, I have to hurry up and get back to work because I won't have a job. You're like, hey, listen, I'm good, And so you want to take this coverage and you want to put something, I say with living benefits, that's you being your own best friend, right? My background is HR. I did HR for 13 years. When I found out about the living benefits and and understood that, okay, I have coverage at my job, but I'm not good because I don't have those living benefits. I dropped the coverage at my job and got something outside because I wanted the living benefits, guys. That's me being my own best friend. I know my family's health history. And I said, hey, if that happens, I want to be able to have a fallback plan so that my family and I are still good. Right. And I'll just share one more example about having coverage at the job. I had a gentleman back in 2020 that had worked with our company for all his life. He graduated from college and came to work with us. We were his only work experience, right? And so he worked with us for 41 years. Well, when the pandemic hit, he said, hey, you know what? I think I'm going to go ahead and throw in the towel and just stay home with my wife and go to church. It's time. And I said, that sounds good. And we retired him. And that was in April of 2020. By August of 2020, or in August of 2020, I got a phone call from his wife saying that he had unfortunately contracted COVID from a friend and passed away. And she wanted to know about his life insurance. Now, he had paid his life insurance without fail because they directly take that money right out of his paycheck for 41 years. But the day he retired, that coverage went away. So imagine, had they not had coverage outside of work for him, she would have had to come out of pocket to pay, although those last 41 years he was covered. So think about that. Don't let that be the only coverage you have. You want to always get something outside of work.
You want to look at if you are covered at work, you want to look at it as a supplement, add on to what you have outside of work, because 9 times out of 10, the coverage that you do have at work is not enough. It's not enough. 25,000, 50, 75 is not enough. And you're gonna find out you need more. And my wife will talk about that later. But that's definitely something you want to keep in mind. Also, we come across clients where they think that they are covered at work and find out that they don't have life insurance. They have something called accidental. So if something were to happen to them at work, accident, has to be an accident, they're covered. But if it's not an accident, they're not covered. So you want to make sure you know what you have, and most people do not know what they have.
So take time and please check to see what you have. But
have someone look over.
Again, term is just one of the different types of coverages, or one of the two that's out there. I'm going to talk to you now about a permanent plan. Okay. So
before we dive into the permanent, I want to bring up this quick question. So Jake Dillon, shout out Jake one time. He's asked who's going to be the beneficiary, but I could answer this one for you. So Jake, the beneficiary is anybody you choose, actually. So usually family, but yeah, anybody you choose that you want the money to go to. So rightfully, when I had my own, I had my cousin as the beneficiary. But yeah, it's up to you. So that's the simplest answer I could say. And then, yeah, just want to show Rodell also say it expires
Mhm.
once you leave the job, like how you mentioned. And that's a rough story you shared about the gentleman, 41 years. And then he didn't get anything. Like he said, it expired once he left the job. That's rough. But at least God bless his family
Did
had
have,
planned, you know, ahead
yes.
and had something else supplementary, or let me say primary then, since that wasn't the
Yes,
primary. But
yes,
yeah.
yes. And you're
And yeah,
right.
Saido also say in response to the question, next of kin would
Hmm.
be
Mhm.
Hmm.
the beneficiary. So whoever you choose as your next of kin, so whether your children, your cousin, your wife, your mother, your father, your auntie, your uncle, whoever you feel you want that money to go to, that you
Yes,
trust that, yeah, this money gonna be safe in their hands and get dealt with, respectfully and responsibly, that is up to you. So
yeah.
all of this is why,
The
uh-huh.
carriers prefer for it to be, a family member, someone that, again, next of kin. So very good. Yes, that's what they prefer. Um, and what else was I going to say there? I can't think. I'll come back to it. But yeah, preferably beneficiaries would need to be family members, so that they can make sure that, it just makes sense. I had a client that wanted to put her roommate down, and they were just like, mm, we need to establish,
That's
the need there.
right.
So,
That's considered temporary.
yeah, so they will sometimes push back. So needs to be a family
Yeah,
member.
anything could happen with your roommate.
Yeah. Yeah, so needs to be a family member, and if they're children under the age of 18, then you want to put them as contingencies possibly, but you need to have someone 18 years of age or the age of majority typically, and you can have more than one beneficiary.
And okay, so
Okay.
All
before
right.
let me just
So let's dive into the permanent option, guys. We've talked a lot about term. On the other side of that, we offer multiple different types of permanent plans, because again, everybody has different needs, wants, and concerns. It just depends on who we're sitting with and what their need is, right? There's one that we specialize in the most that's out there in the market. That's what we call an LIRP, or a life insurance retirement plan, or alert. You guys can look that up. Um, but the easiest way to talk about this plan, first and foremost, you have to design this plan. It has to be designed properly in order for it to work, right? But the way it can be structured is, again, let's say we have this same 34-year-old female, and she has that death benefit of $500,000 of coverage, right? And this time she's setting aside $250 a month that she's paying into this plan, right? Now, a portion of what she's paying into this plan is going to go towards that death benefit, and the other portion of her premium is going to go to what we call tax advantage cash value. So I know someone had commented that there was a company where you can have, that cash and more. So this is a plan just like that, right? So let's talk about it. One, the death benefit, unlike term, this one can cover you up to age 121. So it's not if I die, but when I die, I know my family doesn't have to worry about the burden of burying me. I know
uh-oh.
they're good. That beneficiary is going to get that money, right? So if we look at this a little bit further, let's just say, you know, for let's talk about the death benefit. Hypothetically, Oliver, let's just say you're our son, and we say, "Hey, Oliver, we have $500,000 in a life insurance policy. Now, when we die, half of that money you can do whatever you want with it. The other half, you're going to be required to take it and reinvest it back into life insurance, right? You're going to put it inside of a will and inside of a trust, right? Now that time comes, Oliver, 250,000, you're doing whatever you want, but the other 250,000, let's say you reinvest that back into life insurance, right? And that gets you a $3 million policy. Now you're simply going to do the same thing with your children, right? You're going to say, hey guys, I have a $3 million life insurance policy inside of a will, inside of a trust. Now, when I die, 1.5 million, you guys can do whatever you want, but the other 1.5, you have to reinvest that back into life insurance. And they say, okay, dad, got it, right? Now they take it and they do that. They take that 1.5 mil, they reinvest it. Let's see, that gets them $10 million, right, in life insurance. Now they're simply going to do that for their children. Their children are going to do that for their children. What have you just created, Oliver?
Generational wealth.
Boom, you hit it. Yeah,
That,
you hit it right on the head.
that
Yeah.
is it.
Yes, yeah,
Mhm.
an
That
inheritance,
is
a
it.
legacy. You've created this for your family. Life insurance can forever change your last name, right? All because you took the time to get educated and you put a policy in place. Did you know that you could do this with life insurance?
I didn't know that, like how you say that. No, I didn't know that strategy, but it made me think on the Rockefellers.
Yes,
Rockefellers, yeah.
yeah. The Rockefeller method and how they, have life insurance as a way to continue and maintain their wealth. They have a whole strategy where they meet and they educate their family about, their wealth strategy, life insurance. And so, yes, you want to be able to take this because we only know that, hey, when I die, I need to make sure my family can bury me and take care of any final expense. And if there's anything left over, then it can go to the family bill. Now it's time to start strategizing, because what does the Bible say? A good man leaves an inheritance to his children's children's
Children's children.
children. This is how you can do that, right? And so that's just, one of those benefits, right? Again, you have the living benefits in the same in this permanent plan, the same as with the term. That's those. And let me just clarify, guys, when I'm talking about living benefits, I'm not talking about a terminal illness rider. All plans have a terminal illness rider. And that just means basically that you only have 12 to 24 months to live. And upon your diagnosis, you can have access to that money early. That comes standard with all policies. This living benefit says, hey, I have a major medical illness, again, cancer, heart attack, stroke, maybe third degree burns, paralysis, even Alzheimer's.
Mhm.
This is going to allow you to tap into that benefit, right? Now, on the other side of that premium that you're paying, again, a portion is going towards the death benefit and covering. The other portion is actually tied to the market and, and indexed in the market. And so that allows you to have compounding interest that's growing in your plan and it's building for you, right? And so you are paying that money and it's tied to the market. So the market goes up, you're making money. Some of the carriers have caps, some of them don't have caps, but you're able to make money. But if the market takes a hit, guess what? You're guaranteed no losses because these have what we call a floor in them. So you won't experience any type of losses in this plan. So life insurance is a guaranteed way. This is the only guarantee. And in life insurance, we can say guarantee.
Mhm.
This is the only guaranteed way to be able to build cash in a plan. And it's tax advantage, meaning if taxes go up in the future, you don't have to worry about that because you don't have to pay taxes on this money, right? So this is a good way, just one of the ways, as Clem talked about earlier with the four quadrants of wealth. Life insurance is just a part of that, guys. But you want to make sure you have that set up so that this can protect everything else that you work so hard to build over time.
Correct. And you think about
Right.
businesses, people that have businesses. Think about Walt Disney when he was starting Disney. He used he used his life insurance policy to get Walt Disney off the ground, to get Disney World off the ground. I don't know if you know that. Look at McDonald's. There's a movie on that with McDonald's. If you I don't know if you remember J.C. Penney.
Yeah,
J.C.
that's
Penney.
it.
There was a time when he was going through some hard times. He used his life insurance to pay his employees to keep him on the books to keep J.C. Penney going. So you got to think about that as well.
Yeah, there's no limitations to what you can do with that cash, right? Now, I do want to tell you there are surrender periods and surrender values with those plans when it comes to the cash. Just so you know, I don't want you to walk away and say I didn't tell you. So it does have that on there. So with the surrender periods, that just means that the company doesn't want you to treat it like a checking account, guys. Put the money in there and let it sit, let it grow, right? Let it compound, let
Mhm.
it grow. And then you want to be able to reach in there and use that money for whatever you want. You can use that money if you want to buy a house, you want to buy a car, you want to invest in some real estate. do whatever you want with it, but give it a chance to grow. So that's what they prefer. So that surrender period can typically be anywhere from 10 to 15 years, depending on the carrier. Now, it doesn't mean that you can't touch that money. They just prefer for you to let it sit and grow, right? And within that first 10 to 15 years, that surrender charge is basically saying, hey, you have access to the money, which means you can take it out, but you can't take all of it out, right? Not until we hit that threshold of 10 to 15 years. Okay, so just want to make sure you have that knowledge as well.
Understood. Great. Thanks for sharing. I just want to say shout out to my mother in the chat. Yeah.
Oh,
Gotta see my mother join. Good evening, my mother. Blessings. But yeah. Oh.
So with this slide, I like to talk about the high cost of waiting, guys. So when it comes to retirement, people usually will say, well, listen, if I want to be, have $1 million, and for saved up for retirement, how much do I need to start putting away? And how soon, right? So this slide just illustrates that, and there's an example here that says monthly. This is a monthly savings amount that you need to reach $1 million in retirement, assuming that you have an 8% rate of return and the tax deferral, right? And so if you are, let's say you have 40 years until retirement, if we look at that first step, right? 40 years until retirement, your monthly amount that you should be setting aside is $286 a month. Right. But if you say, hey, I'm still young, I have 40 years before I retire, I'm and this is assuming, I think, 65 years of age as your retirement, right? So, hey, I'm still young. I'm not ready to do that yet. So you wait until you wait 5 more years, let's say, and then you get serious. Now you want to start putting money away. Well, look how that has pretty much doubled with how much you have to set aside monthly. Okay. And if you continue to wait an additional 5 years, guys, if there's only 20 years left to your retirement, now you've gone from $286 to $1,697 that you have to find and put aside monthly. So time is on your side. The sooner you begin, the better, right? Now, if you're 5 to 10 years out, guys, look what that means. Put time on your side, because if not, 5 years out from retirement, if you're 60 and you want to retire at 65 and you want to be a millionaire, do you have $13,000 set aside that you can just put, no, we don't. We do not. So this is just here to show you and give you an idea of what you want to, the actions that you need to take. You need to take action now. And a lot of people, when they get ready to retire, they say, well, listen, I'm ready to retire. And I don't know what my options are. I want to make sure I can keep my money safe, right? Or they may have an old 401k IRA that's just sitting out there in the wind. It's floating because maybe they were working at a job, but they left and now they're at another job, but they never moved that money, right? So let's talk about some options on what you can do to help protect. Again, we come from a defensive strategy, right? So what can you do to protect what you have, right? So your traditional accounts, when it comes to retirement, includes your 401ks, IRAs. If it's a 403b, 457, right? When you have money in those accounts, you're making money when the market goes up, right? But what happens when the market goes down? You're losing money, right? So you see that loss with the money, right? Now, if there was an option where you could have the ups of the market, but none of the downs, would you prefer that option? Yes, everyone would, right? Which would you prefer? You want the ups and the downs, or you want all the ups, none of the downs? Which would you prefer, Oliver?
I would for sure take all the ups, no downs.
No downs, right? All the way
No
up, right?
downs.
Right?
Yeah,
Yes,
straight.
right. Okay, and then let's say now, would you prefer fees or no fees? Your typical 401k and IRA, they come with fees, and you have the option of no fees. There's also no guaranteed income in a 401k and IRA. Now, again, you have the ability to, make money in the market, but what we're looking for here is guarantees, right? So would you prefer a guaranteed income or no guaranteed income?
Guaranteed income. And
Guaranteed.
with no fees for
with
sure.
no fees. You can go ahead and bring that up. Yeah, yeah, yeah.
Yeah, no fees.
No fees. A lot of people think that 401ks they are not aware that the 401ks have fees. They do. They do. And it's anywhere from 3 to 5%, guys. And if you leave a job and you don't move it, it increases, right? Automatically, just by doing away with the fees, you're automatically creating more income or more money into your retirement, right? And so we have clients that are not paying any fees when it comes to protecting and having a retirement for the future, right? So I can tell you the happiest people that are in retirement have no fees and they have a guaranteed income. And then lastly, no long-term care option. 401ks, IRAs, they don't come with long-term care options, right? And again, if you're thinking about how do you protect your money and make it last and make it stretch, you want to make sure that you are thinking about all of these things. So would you prefer an option where you can get long-term care? There is an option that will give you that long-term care. And what it will do is not only will it give you that long-term care rider to be able to use in the case of you need nursing home care, skilled care coming into your home, you'll have that as an option, but it will double for a period of 5 years and help you cover that cost with the payout of it, right? So again, which would you prefer? Long-term care option or no long-term care option? It's a no-brainer.
Long-term care option.
It's a no-brainer. Well, you get that, all of that you can find in what we call an indexed annuity, right? That indexed annuity would give you all of the ups with no downs. So you're guaranteed never will you lose money in your retirement account again, right? You're going to get that guaranteed income for life because a lot of people are typically asset rich, but cash poor or liquid poor, meaning they don't have access to money right then. And so what you want to be able to do is you want to have access to money, right? So that guaranteed income that's coming in, that's going to help you to be able to make sure that not only are you designing, a lifestyle, but you want to retire because think you want to retire well. Think about it. When you're retired, what's the day of the week that we spend the most money?
Friday.
Friday, we're happy because it's the weekend, but then Saturday, we got nothing to do but just spend money and go out and just so in retirement, every day is Saturday, every day is Friday, every day is Saturday. You want to make sure that
Spend
you
money.
coming in so that you can continue to do that, right? So this is just a way that you can do that and still make sure that you are good when it comes to retirement, right? And ultimately, guys, when it comes to the simplicity of this, right? Let's say you have a 401k and you're retiring or you have an old 401k, right? You take that 401k, it's sitting over here. And if you want to put it into, if you want to take advantage of these benefits, all of the ups, none of the downs, guaranteed income, no fees, long-term care option, all you're simply going to do is take your 401k and move it over here to an indexed annuity, or you're just going to roll it over. You don't take the money out. I don't get the money. It stays in your account and we let the two companies talk, and you're just simply taking that money and moving it over to now an indexed annuity, right? Some people don't realize and believe that it's just that simple to be able to do that because again, it's not about how much you make, it's about how much you keep. And if you're 65, do you have time for the market to recover so that you can make up the money, possibly make up the money that you have in your account? No, you want to protect what you have.
And we walk you through that.
Okay. That sounds good. That sounds good.
So as we get ready to wrap up, we talk about how much insurance is needed. A lot of people say, "Well, how much do I need?" And so here's just a quick little formula that we use to help determine how much life insurance is needed or what your insurable need is. And so we have this acronym that we call DIME, but we actually added the L for long-term care and legacy. So you can go ahead and bring that up. And with the DIME, what we're looking at, or with the DIME, excuse me, what we're looking at is when you're trying to figure out how much coverage you need, you want to consider how much debt you have, right? That's the very first thing. You want to look at how much outstanding debt you have, whether this is loans, student loans, credit cards, medical bills, anything that you have. You want to be able to get a total of that, right? And write that out. Okay. Now, when it comes to income, you want to make sure if something happens to you, that your income is replaced, because your family is depending on you to help pay those living expenses. So we typically say take 10 years times your annual income and go out 10 years. And that way it makes sure that your family is good for the next 10 years, right? With the mortgage, what's the remaining mortgage that you have on your house? Or if you're renting, take your monthly rent, multiply it by 12. That's what you pay annually. And you're looking to rent for the next 5 years, you can do that, or whatever number you think is needed, you can put that there. But on average, we say about 5 years, because think about it. When you buy a home, right, you have to pay that mortgage insurance because you have to protect the bank. You want to put something in place to protect your family so that if something happens to you, it doesn't all fall on one, either the spouse, or if you're single, then what's going to happen to your family? Are they now going to have to be uprooted out of the family home and move out? So you want to make sure you have this in there. Okay. If you have young children and you want them to go to college, then you want to include that in there. We say it's about 25,000 per year. So you multiply that times 4 years for a standard bachelor's degree, that's $100,000. And if you have 2 children, then you need to put $200,000 in that amount to help come up with your total. And last but not least, again, you want to have something for long-term care, be it the living benefits, but you want to make sure that you're having that figured into that as well. Okay, and so that's how you can come up with the amount of coverage that you need. But we sit with people, all of our clients, before we put them in a policy or put them into, get them a policy or coverage. We look at what is your insurable need. How much do you really need? We're not pulling a number out of the sky. We want it to make sense for you. Okay, so that's where we start when it comes to looking at what your insurable need is.
Understood.
And last but not least, I think, is which makes most sense for you and your family. You have some options here, right? So we've talked about term. You can do a hybrid. You can do term and perm, or you can do permanent, right? So let's explore all of them, right? With a term, remember, it's affordable, but it will expire. It does come with those living benefits. And as I mentioned, for every 50K of income, you want to have $1 million of coverage. That's what we recommend, right? But if you can't start with that, then start with what you can. Who would be a great fit for a term is someone who may not have, maybe their budget, they're very budget conscious, and they need to make sure that they can only get a certain amount because this is all that they can afford. Guess what? You can afford life insurance. There's policies out there. We can help structure and get you coverage, for pennies on the dollar, guys. And so if you're tight, budget's tight, let's start with the term. Start with the term, and then if when you get to a place where you could get a permanent plan, that's the goal, right? Maybe you're married with children, you might need a term and a perm, right? Because the younger your kids are, the longer they have until they reach the age of majority. Maybe their budget could be a little tight because you got young children in the home. But you want a term and a perm, guys, because once that term expires, you want to make sure you have that permanent coverage there so that you have it already in place. Because think about it. Let's say you get that coverage and now you're older in life, you're 75, 80, right? That term is probably expired, but that permanent is still there. And you actually locked in those rates 30 years ago. So you're paying the lowest rates that you could pay for that, for that plan. And then a permanent plan, typically these are your young, healthy men and women that, don't have any responsibilities. They can go ahead and start out with a permanent plan, and then they can add on a term if they get married, have children, their responsibilities increase, their expenses increase. They can get add on a term later. You can have more than one type of coverage, guys. I know I said earlier, we have a term, we have permanent, our children. We actually don't write terms on children, so our children have the permanent plans. Those permanent plans allow us to start them at ages, what, 2 and 4. And now we're just paying money into those plans. And guess what? That cash that's building up, if they decide, hey, college is the route they want to go, then that's money that's going to help supplement their college. If they decide, hey, that's not what I want to do, then that's money that's there and they can use that money. It's going to be a good, starting or stepping stone for them to be able to start out in life. But these plans are, you can choose any one that best fits your situation.
That's a good point. And I think that's a good segue for me to share my personal story.
Yeah, because you
I
keep
think
saying had, so I'm interested. I've been keeping it right.
so. Yeah, I had to say had because I don't have it anymore, unfortunately. But I'll explain. So after my studies, when I was living in Florida, Miami, Fort Lauderdale area, I was working with the company Career Source, and one of my colleagues actually was an agent. So he invited me. I went, and it interested me. I guess because he knew I was like dabbling in the stock market and things of that nature as well. I guess that's why he invited me to it too, because my current thought processes, he probably knew that, especially when I heard about the cash value aspect, that would have like really intrigued me, which it did. So based on what you explained just now, I believe I had a hybrid plan because I could say my monthly premium was low, like less than 100, but I had coverage of 500,000 death benefits and life benefits, but also I had a cash value, which what really had amazed me, which looking back, I see the real value of what I had is I had the plan for maybe about 6 months because I got it while I was working, but then because my visa was expiring, circumstances, I moved back to St. Martin and yeah, decided to close the policy, which I, of course, inquired penalties, but I still was able to get my cash value that I had already accumulated. So it had amazed me that within 6 months, I was able to accumulate over $1,000 US, which to some might seem small, but honestly, looking back, I'm like, it's amazing that I was able to get that type of return in that short space of time. Like, is nowhere else I could really think on, other than the market. If you really catch a good day, like you gotta be really good to get those type of returns, and it's not gonna be consistent either. So I could say after doing some more research and doing some research about like people talking about using life insurance as a bank,
Personal bank.
then is when I really realized like, yo, Oliver, you had one of these, like you had this, like if you had keep that, like by now you probably would have been like on a whole different level, but like I say, circumstances, I probably wouldn't have been able to maintain it for the duration, but yeah, it's just amazing for myself to see the value and the power that it's providing, so that's why personally I felt like it was mandatory to
Mm-hmm.
have this as a topic, and I feel great that I was able to get you both to come on and express it in such a clear, concise manner that people could digest it so well. Good evening, Rita. Thanks for joining. And on that note, I'll say I know we do have one more slide.
Yes.
So if anything, you want me to bring up everything or
Yep, you can bring it up because
And I'm sorry, baby. Let me just say, Oliver, you know,
Huh?
we all go through a stint of hard times, right? And if you have something, we tell our clients, when you have this in place, if for any reason you're going through something, call us, let us know. There are options to make sure that you keep this policy in place. So I just want to say that.
Good point, good point. And
Yeah.
thanks for sharing that for me and the viewers.
Yes. Yeah, because as a matter of fact, with the life insurance retirement plan, the LIRP, we're going to talk about it here. Those are flexible premiums. So it sounded like, Oliver, for you, what you were doing was possibly max funding. Usually, max funding your policy or putting, maybe more than what the actual required premium was in it. And that's a great thing because that's what allows you to be able to accumulate cash faster, right? And so it sounds like that's what you were doing, and that's what we encourage all of our clients to do, is to go ahead and put more money in there as you can, and that'll allow you to access cash faster. That's what Clem and I do, and we were able to actually, just like you, pull and take money out of our plan to be able to use it for whatever we needed it for. We actually think we did that this year. Last year. And so it was just, oh wow, man, it's already accumulated this amount of money. He pulled some from his policy, I pulled some from mine, and we were able to take care of some things that came up. And so it's there, but it allowed us to grow cash a lot quicker because we were putting, not just the minimum in there, we were actually doing more. And maybe you can't start out doing a lot more, but start out doing what you can, right? Do the minimum and maybe a little bit more. And then over time, you can put more in there. But too, if you fall onto a hard time, there are flexible premiums with that life insurance retirement plan. And it'll allow you to, hey, if you're having a hard time, maybe you have to drop down what you're paying into it, but don't stay there. Do not stay there, or you run the risk of, the policy lapsing. And so, just FYI if for individuals that may not know, don't ever just let it go. Reach out to your agent and just say, hey, what are my options, right? Or reach out to the company directly and ask what are my options.
Understood.
Perfect.
Understood. And to your point that you just mentioned, I think if I recall correctly, the company had a option that they would match like the portion that going into the cash value. And like you mentioned, the cash value is like in the index. It's compounding and increasing through being placed into the market, and you don't get the negative hits, you only get the positives. And I remember that being explained to me as well. So,
Okay. Yeah. With this last slide here, with the whole life versus the LERP, basically what I'm going to do is because a lot of people will say, well, I have whole life. What's the difference between a whole life, and this plan that you guys have been talking about? So I'm just going to, one's not bad versus the other. I have clients that I put in whole life policies all the time. I have clients that I put into the IULs or the LERPs. It just depends on what their need is, right? We look at their need and we will set up the plan that makes sense for them. But let's just talk about, you have to know how they compare, right? So a traditional whole life policy, because a lot of times our families only know of whole life in term, or they only know of whole life. They don't know anything about a LERP or a life insurance retirement plan or IUL. So with a whole life plan, right? You have the death benefit, right? You have the cash value. You have a permanent death benefit. Let me say that. You have a cash value, and that 3 to 4%. That's a fixed interest rate that you're getting, right? So something happens to you, your beneficiary is going to get $500,000 of that death benefit, right? But let's just say now that there's that $25,000 of cash that's in that plan as well. Well, upon your passing, your family does not get that cash value. That cash value goes back to the company, right? Oh, now let's say if you have a $500,000 of coverage and you decide that, hey, I want to take um, I'm sorry, you have that $500,000 of coverage, but you have that $25,000 of cash in there, right? Let's say you want to take $20,000 out of there and you want to buy a car with it, right? So what they're going to do is they're going to take that from the death benefit, right? So they're going to drop that death benefit down dollar by dollar for dollar. So if you took out 20, they're going to drop it by 20. So now there's $480,000 in there, but you have you have some cash that you've used of $20,000. Now, let's say if something happens and you were to pass away today, your family would only get $480,000, right? And whatever remaining cash, that 5,000, if you haven't paid it back, it's 5,000. That still goes to the company. But you may say, well, hey, listen, I need to make sure I have a $500,000. I have some things going on. I want my family to make sure they have that 500,000. Then you can say, okay, well, I'm going to pay that back. You can pay that back, right, to the company. But now that you're paying that back, you want to put that back, they're going to charge you a loan rate of 5 to 8% to put that money back, right? So you're thinking, okay, I'm going to put that death benefit, I'm going to put that money back so that my death benefit can go back up to a $500,000. That $500,000 goes, it goes back up. Your family gets that $500,000, but that cash that you repaid to get it back up to 500,000, your family still doesn't get that cash. That cash still goes to the insurance carrier. Okay. So that's how the whole life works. It may appear that you're paying that cash back and your family's gonna get that, but no, your family only gets the death benefit because this is what we call um, a level plan or a level death benefit, right? So your family's only gonna get that $500,000, right? If we look at over here to the right, the IUL, the Index Universal Life Policy, or the Life Insurance Retirement Plan, we use those terms interchangeably. So here, the difference is, well, one, you do have a death benefit. You have the cash value, just like on the left side with the whole life, right? But in addition to that death benefit, you're also getting access to the living benefits, and you have that tax advantage cash that's growing in that plan. And this has to be designed, and again, designed properly, because we're going to design this as an increasing death benefit. On the left with the whole life, it's a level death benefit, just meaning that the death benefit will not increase. But here on the right with the life insurance retirement plan, it will. It will increase because we're going to design it as an increasing. And basically, what we're saying here is, yes, you have that death benefit upon your passing. Your family will get that $500,000 of the death benefit, but they also will get that cash value of 25,000 as well. So, do you want your family to get a $500,000 of coverage, or would you like for them to get $525,000 of coverage in coverage, right? So they're getting both, right? And in addition to that, they're getting those living benefits. So maybe you have a whole life plan, but you just need to maybe just level it up and take advantage of those living benefits, and also have your family get both the cash and the death benefit.
Good point, good point. And yeah, for sure, like we say earlier, we're going to go with the no fees, the more money, of course. Yeah, yeah, yeah. Don't cut
Right,
nothing. I
right.
want all of it. Like Nipsey Hussle will say all money in. Yeah.
Mhm.
Absolutely,
Like
absolutely.
the old commercial when it's my money and I want it. No, yeah.
But yeah, that's that's life insurance, guys. It's simple. I'm glad that everyone that's tuned in, you're able to hear these principles and walk away with an understanding of life insurance. But if you guys we have time for questions. If there's any questions, we'll be more than happy to answer any questions.
Sounds good. That is it. So what I will do is I'll bring down the slides. And I do have some questions, but yes, my dear viewers, any questions you have, you can leave in the chat. I'll recap one or two questions we had already, which one was we already answered. Jake asked who's going to be the beneficiary, and Saido actually assisted us with the
Next.
answer, next of kin.
Thank you.
And yeah, we had a question. Well, that wasn't really a question regarding when we was doing the example with the 30 years after it expires. Yeah, you'll have to try to renew, but unless you do that, that money is not going to you. But anyways, to move on to my question, I want to ask you first, what are some common misconceptions people have about life insurance?
Sure. Great question. A lot of people just automatically, when you think about life insurance, they think it's just too expensive to get, Oliver. They see it as another bill versus it being a way to protect your family and a necessity, something you need to have. You can get a life insurance plan again if you can't afford a permanent or pay a huge premium. If you see that as huge, then start with a term. Start with a term. You could get a term, you can get coverage $15 a month. you know Young guys that I've worked with, they want to make sure they have something in place. I have them, I write the policy, we write the policies for them. And their premiums are like $13 a month, and if they are in excellent health, it even will drop it lower, and they can come back as applied, approved better than applied, and now their premium is just $11 a month, right? And you're talking about your 19 and 20-year-old guys that are, looking at getting a, a half a mil or so with life insurance as a term, because they start out there, that's what they can afford, but they want to make sure they have something in place so in case something happens to them. So I think that's the common misconception, or at least one of them, is that it's too expensive, and it doesn't have to be. The average family has they have subscriptions. They're paying about $62 a month in subscriptions,
More.
yeah, with Netflix and Prime,
Amazon Prime.
Prime,
Can't
and
forget Amazon.
we're paying for those things, but yet we are leaving our families unprotected. And so it's like, okay, let's rethink this. Let's reprioritize, and let's make sure we have that peace of mind in place. And now with the living benefits, not just for your families, but for yourself, right?
Yeah.
Yeah, I agree. And so basically, too expensive. I agree that that is surely one of the most common misconceptions.
Or for
Do
the
you
wealthy,
think there is that?
only for the
Yes.
wealthy, or I'm too
Young.
young, or it's too late, or I have this medical condition. There's no way they're gonna
Cover.
insure me, cover me, and that's just not the case. We've had so many experiences with clients where we're actually able to cover them. So
Understood. And to the point that you made just now about like the young, healthy 19, 20-year-old policy holders, let's call them. I want you to touch on that when it comes to the health and risk factor regarding the policies and the life insurance. Because I remember in my case too, that was a big factor, that the fact that I didn't have any health complications. Like I'm a healthy young child. I just say like, any young lady get me as a husband lucky. I'm a good breed, you know? So I was fortunate enough that when I did look into the policy, I didn't have any health complications. I wasn't a smoker. I didn't have nothing that would make them say that, let's say, I'm a risk. So because of that, I was able to get a low premium as well. So I would like you to just touch on the health factor and the risk factor when it comes to these
Yeah, sure.
topics.
Yeah. Again, the younger you are, the more affordable, and that is the time to get the coverage, Oliver, because you can lock in a rate. Even if, let's say you start with, again, you know, if you're young, we always say if you can put a permanent implant, excuse me, put a permanent plan in place because you start young and that premium, is only but so much, right? And then let's say you put more, you're paying more towards your monthly premium, that's just allowing you to build cash a lot faster. And let's think, you have this, you're 20 and you have this plan in place for the next 40 years and plus, you right, that's cash that's growing in this compounding interest daily for you in that plan. That's going to be a great supplement to your retirement, right? And so, because it doesn't have to be the only thing, right? We're not saying insurance has to be the only thing, but now is the time, because as Clem mentioned earlier, you never know when your health status can change in the blink of an eye. And so you want to have coverage in place. The best time to get it is when you're young. The rates are on your side when you're younger. And so you just want to be able to lock it in at that time. And, I can share a story with you. One of the clients um, that we had is he was a 26-year-old. And he sat down and said, hey, listen, I think his policy came up to about, let's say, $30 a month. He was like, oh, I can pay that, no problem. I think he just got $100,000 of coverage. That's what he can afford, and he'll pay about $30 a month. And he 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 was like, yeah, I spend that, and just going outside, I can spend $30. So we said, okay, well, yeah, let's go ahead and put the coverage in place for you. And so he had his plan in place for about 4 months. And then he started getting these stomach pains. He was diagnosed with stomach cancer. And he actually remembered, hey, didn't you say I can use the money in this plan to help with the medical bills? Yeah, you can. And so we were able to help him. I think they dropped $80,000 into his bank account, so he could use that money to pay for that. He paid for his treatment. He was still able to maintain his level of living, his lifestyle, because he didn't have to stress about not being able to work. He just used that money that he got to be able to pay, his medical bills or what have you. I think the only thing there is that there was a regret that he didn't get more. And so, because now there's a wait period for him to be able to reapply, and then there's going to be some restrictions on what he can get now. But yeah, when you're younger, that's the time to really go all in, guys, and start thinking about your future now, right? Again, put time on your side.
That's a good answer. And I like that answer actually answer like two questions in one, because like how you mentioned about the living benefits, I was going to ask you to elaborate a little more on like what you could do with it. But I find that's a good example, because some people might feel like it's only for terminal illness, only if you have cancer, diabetes, or something like that. But like you mentioned, it could be for that, but also it could be just to help you with the expenses, to help you with your living expenses, and all these different things. So
And let
yeah,
me clarify, so that, yeah, thank you for bringing that up. When it comes to accessing those living benefits, there has to be a trigger of a major medical illness. So that's why we say cancer, heart attack, stroke, third degree burns, paralysis, again, Alzheimer's, dementia. You can, you know you get diagnosed with one of those illnesses, that triggers us to say, hey, let's file a claim. Let's see if we can get this claim approved for you so that you can get access to this money. Because again, your job is only going to protect your job for 3 months. And then after that, if they decide to extend that ADA leave to you, then great. You have the leave, but guess what? The FMLA and the ADA, that's all unpaid. That's unpaid. You don't get paid while you're on leave from your job. And so, if you want to be able to know that you have a peace of mind financially, you want to be able to put this coverage in place and put this on your, put that living benefits on your side.
true that, true that. Um, let's say if there's someone out there listening that does have a health complication already, but maybe they're watching this and they feel like, maybe I could get life insurance. Maybe I could go look into getting a policy now, and that could help me manage or see myself through these medical issues. What would your response be to someone in that situation?
So,
I was gonna say, don't wait.
yeah.
Don't wait, because we could get you. It's possible that we could get you covered now, but if you wait, that window could be closing rapidly, and once that window is closed,
It's
that's it.
hard to be open.
I'm gonna tell you a story. There was a there was someone that I was a business owner. A business owner. He had his own little business, and we were talking, and he was like, "Yeah, I need to get life insurance." I said, "Okay, we'll sit down. Let's sit down and talk." Him and his wife, right? And it kept following up, following up. He's like, "Oh, I can't decide. We're so busy. We're so busy. This and that." Then after a while, I didn't hear from him. I would call, couldn't reach him. So I decided to go up to his shop, and he wasn't there. There was another individual there, and I was like, "Yeah, I'm looking for so and so. Don't want to say any names." And he was like, "Oh yeah, yeah, he's just not here." So I said, "Okay." Try to reach out to him again, and then finally he reached out, and I was in the middle, speaking something like that, and he was blowing up my phone, and so I touched back with him, and I'm like, "Hey, you okay? Everything's okay?" He's like, "No, man. If we can sit down as soon as possible." I'm like, "Yeah, sure. What's going on?" And he's like, "Yeah, I was diagnosed with colon cancer, or no, pancreatic."
Oh,
And I was like, "You were diagnosed, or you were what happened? Tell me exactly what happened." He went in for a checkup, and they took some tests, and he was diagnosed. And I was like, "Man, there's it's too late. There's nothing we can do. It's not something, not anything. Final expense. There's nothing we can do. There's no carrier that's going to cover you. And he was angry, and and I was like, "Well, I we kept calling you, wanted to get you placed, but it's too late now." And then sadly, after a few months, he passed away. It was rapid, and he was gone. And that's the unfortunate side that we have to deal with sometimes. So I would definitely say, don't wait. Um, get with an agent. You can give us a call, and see what we can do.
If you're going through something and you have an illness, let us sit with you. We'll get the details. We'll we'll do our due we'll do our due diligence by reaching out to the underwriters and asking, hey, we have a potential insured. They're interested in coverage, but these are the health concerns that they have. Are they eligible for coverage? And if so, please give us a tentative rating for them. I've done this multiple times with my clients. I just got had three clients approved. One had a spinal cord leak, and I wasn't sure if we were going to able to get them coverage. But guess what? God's good. We got them covered. One had depression and anxiety, and you may think, oh, well, will that stop someone? Some carriers will say no. Other carriers will say yes, right? And my other client, I'm trying to think here, I can't remember off the top of my head, but we're able to get. Oh, I think she had a when she was younger, she had attempted to take her own life, and so they take all of that into consideration, right? But we were still able to help them find coverage. So don't wait, and if you are not sure, you won't know unless you take that chance and you have the conversation. At least have the conversation. Let us see what we can do.
yeah, at least checked out, and that's sad. Sorry to hear that, but yeah, that gives you perspective, and I'll say unfortunate that that happened, but we'll change the mood a little bit just now. Before we move on to the next question, Saido had a question. I ain't gonna lie, I was kind of struggling getting through it. Do you have any policy in place for clients, and how are you monitoring the client effectiveness? So I guess the first part kind of confused me because I would say, yeah, of course, you have different policies for your clients.
Mm-hmm.
So yeah, for
So
sure, you have, like you say, maybe he wasn't on when you were showing like the different companies you worked with, maybe.
Mm.
But yes, for sure, like you was mentioning, you have different companies that have mm, centuries that have been around since 150, 170 something years that that you work with, and different entities that offer different types of policies and different offerings. So because of this, you are able to go through and do your due diligence and see who would be able to work with each client
mhm,
Mm-hmm.
based on their situation.
Right.
But
correct, correct.
And once we have a once the client has a policy in place, we're always following up with them, and we know exactly what's going on with their policy. So sometimes we'll even follow up and be like, hey, did you look at your policy lead? Did you know about this? Did you know about that? So
We like to do annual reviews with our clients at least annual reviews. We can do 6 month reviews depending on what their goals are. I've had clients, I've met clients, and the very first time that I met them, they're like, okay, well, I don't want you to get off the phone until we put a policy in place, because they understand the value of what that this can do for them. I have other clients that say, hey, okay, this sounds good, but I need to, let's touch base in 2 weeks, maybe a month from now or 6 months, I'll be ready, and I can't force it upon them. But what I can just say, listen, I'm going to do my part and I'll follow up with you. But we stay in touch because we don't want to just service you. You know, I hope that if anything, people come away with value from the information that we've shared tonight. And if you felt that this was information that you found valuable to you, that who else do you know that could benefit from this information? So not only do we want to help you, but we want to help those that you love as well. So we don't just have, a client, but we want to be the insurance agent for their family, because we want to make sure they're taken care of. I'm not going to put you in a policy that I wouldn't put my own mother in, or my own family. And I want to make sure you are taken care of. And so we have those clients, and we speak with our clients, and, talk to our clients, on a regular basis. I follow up like, hey, how are you? I know you said not yet. Are you ready now? Or hey, we got it in place. Let's take a look at the growth that you have. Let's take a look at, you weren't ready to do the permanent. You could only afford term, but now you're ready to move forward with that permanent plan. The great thing, guys, I don't think we mentioned this before, but if you get a term plan in place, maybe you can't afford a permanent just yet. You can get a term, right? Let's say you get a 15, 20-year term. You have 15 years, 20 years, whatever that term period of time is. You have typically up to about that amount of time to convert that to a permanent plan, right? And still using those same health rates that you have. So let's say you got a term plan in place, and 5 years into your coverage, your health took a turn for the worse. Now, if you wanted to apply for new insurance, you'd have to use your current health rates, right? Your current health status. Well, if you had a term that you established before your health took that turn, we can take that term and we can, convert it to a permanent plan. And they're going to use your health rates from before. I just did that with my brother-in-law, and we were able to take his term and convert it into a permanent plan where now he's able to build cash and, uh, plan and prepare for the future.
good, sound good. And on that point, my brighter note was life insurance as a wealth tool. So, like how we touch on it in different instances this episode, but basically, also did some research with this gentleman Marvin Mitchell. He has different like videos and podcasts interviews that he did where he talks about using life insurance as a bank,
Mhm.
or should I say leveraging the life insurance to buy assets.
Mhm.
He terms it as using it as a bank, but
Yeah,
basically he using it to buy assets. So can you give us an example of how that would work in real life?
sure,
Yeah.
sure.
Well, first I want to just clarify something because most people say you hear that you can use your life insurance as a bank or what's the term? Infinite banking. So and they hear most people hear that and they're like they run with it like, oh, I can take $100 and put it in. No, no, it doesn't work that way. You want to make sure you have enough money to put into it so you can actually see that money grow and compound. So that's just wanted to clarify that.
Okay. So
What
thank you for that.
what
Go
I
ahead.
could say, I just wanted to say what I could say on that point is he did, at least for the research I did with him and the other people I heard say, they did mention that I don't feel like, yeah, you could just start it up today and tomorrow you could go and invest in something. No, like leave it build up first and then you could
Yeah,
tap into it and use it as like a leverage for yourself. But yeah,
yeah,
sorry, I didn't
yeah.
want
No,
to cut
no, no,
you off.
no. Yeah, no, absolutely right. I had a potential client come to me, and he was taking a real estate investment course, and the guys that were teaching the course were saying, get your life insurance, get a life insurance, get a life insurance plan. So he reached out to me to get the life insurance plan, and I said, okay, well, yeah, we can certainly do this, and we can structure it so that you're building that cash. But what he didn't understand was just because you put it in place doesn't mean that you automatically have access.
Yeah.
He thought that, okay, once he has that plan in place, he can tap into it and use that money to go and invest into a real estate property and make that money back and put it. I said, no, you have the death benefit there if something happens to you or you have that major medical illness, then you can leverage that. But as of right now, you have zero access to any cash. They're not just going to give you, that plan. But the life insurance retirement plans that we talked about, right? That we talked about, those are the plans that you can use so that you want that type of plan. There's multiple plans out there, but that is the plan that if you maximize it, we call it max funding. If you put, that money in there, then you're able to build that cash up so that you can use that money to be able to do whatever it is that you'd like to do, whatever you don't want to do with it. We have conferences, at our company, and we've had some of our guest speakers come out, and they have been, proponents for life insurance. For example, Master P. He was a guest speaker on our stage a couple years back, and how he got started with No Limit Records was his what was it his uncle?
I believe it was his uncle
I think he
left him.
said when he passed, he left him as the beneficiary. So he used the money for the life insurance policy. And his words were, hey, listen, I used that money to start the record label because if the money that we can get from life insurance is if everybody had life insurance in the hood, then you wouldn't see as much poverty. You wouldn't see as many problems, as much violence, because people are, they have a way to be able to live without, having to resort to all types of, um, uh, selfish ways to try to make it. You know what I mean? And so he is a big proponent of life insurance. We had Waka Flocka come out, and he's a huge proponent of life insurance as well. And so um,
Shaquille.
Shaquille O'Neal, come out as well. And if you think about some of the um, some of the big name star like NBA stars, I think it was Stephon Curry.
Mhm.
He just even he put a life insurance retirement plan alert, in place for himself. Yeah, and he may be making money, but it's not just about, is he going to be able to play basketball forever? He's trying to make sure he's protecting his assets, and again, come from a defensive approach. You want to protect what you have and make sure that it continues to grow so that you do have something to pass down. And so you can use the money in those plans to accomplish, whatever dreams or goal. If you want to expand, let's say you're a business owner and you want to expand, or you want to open and you want to scale your business, and be able to open different locations or what have you. Instead of having to go and apply for money through the bank, you just borrow that money from yourself, or you take it out of your, plan, but then you pay it back so that you can keep that money going, and keep it in there. So there's just so many different ways that you can utilize. And I know Clem shared some old school examples of Ray Kroc and um, uh, Mr. J.C. Penney's and Walt Disney World. I mean, who would have thought that when Walt Disney wanted to start Disney World, that the banks didn't see that as a profitable idea? Can you even
Imagine
imagine?
that.
They thought it was just like a seedy idea, like who's going to take their kids to an amusement park, a theme park. And now, he said, okay, well, he was undeterred. He used the money in his plan, and now look at Disney, and it's the happiest place on earth, the most visited place on earth. And
The most worn out place on earth if you're taking kids.
be prepared, be prepared. You don't need the 2 days to rest, but I digress.
No, but that's actually powerful because that shows like the true power. That shows how powerful life insurance could be. Because look, like you say, he didn't have to die. He didn't have to die, but he still was able to leverage the power
Leverage
of
consequences, yeah,
life insurance, and look where that company is now.
today.
Disney World, Walt Disney, TV shows, Pixar, all kind of different
Oh
things.
yeah.
Yeah, so that to show you like it really is a proponent for wealth, a tool of wealth.
But it
So
took him sitting down and putting that in place. So if anything, guys, if you walk away with anything tonight, take time to put a plan in place for yourself, for your family, what have you, so that you have access. This isn't, these plans have been around for over 100 years, but we're just now starting to have the conversations in our circles, So now that you have this information, go ahead and take action. Don't just take the information, take action.
nice. I was gonna ask you if you had one piece of advice for anybody
Oh, sorry.
about this, but I think that's a great answer. I I actually was gonna ask too if you have any powerful stories, but I think we don't cover all of that. That one Disney story, no limit. Like whatever angle you want to take it from, you have a story here. You have some type of inspiration here in this episode. So I I love that. I'll ask you, Clem, if you have any last piece of advice you would like to share on financial literacy and insurance. We
My wife has taken over this podcast, so she said pretty much said everything. I would have. There is one story that I could share, that about a client that wasn't sure about life insurance, and but they went ahead and they saw something like this, like what we did, and they went ahead and got covered but covered the whole family. They had kids, in their young kids and in their 20s, and maybe I'd say maybe 6 months down the line, there was a tragedy where their daughter was in a horrible car accident, ejected from the car, and to the other side of the road, rolled over multiple times, just horrible accident, right? And you can't get your daughter back. You can't get your daughter back. But she got peace of mind because she was able to, she had the death benefit. And this, you're talking about 6 months. They've only been paying on this for 6 months, right? But she was able to get another house because she couldn't live in the same house. They couldn't live in the same house with that they raised their daughter in. So
Thought,
able to,
yeah.
right. So able to get a new house, able to start over, you know. And these are the stories that these are the stories that we see in this industry. And once we're in this industry, like, your eyes are open to, number one, either people that, how many people don't know about life insurance. Maybe they know about life, a little bit about life insurance, but not enough, not the important things. Or maybe they have life insurance, but maybe they're not properly covered. Maybe they're paying too much. Maybe they're not covered enough. Maybe they're covered too much.
Mm.
And and then unfortunately, some of the stories that we told you today, like with the with the individual, with the man with the that had the business, and that these type of things that we see fuels us, and we end up realizing that this is a crusade. Everyone needs to know about this and know what life insurance can truly do, not only for you, but for your family, for your legacy, to build a legacy. So that's what I was saying.
That's powerful. That's really powerful. And I understand, I appreciate that, and I feel the same way. It's mutual. Like, that's why I just come on here every week faithfully, trying to just share the knowledge wherever I know and hear that I could share, that I feel would be valuable. I just try to spread the knowledge, spread the wealth,
And we
and
appreciate you. Keep doing it. Keep doing
Yes.
what you're doing. You're part of the crusade, brother.
appreciate it. Yeah, I think so too. Lions and wolves. Yeah. That is it.
Yes.
That is it. So I'll just say, how let the people know how they could get in touch with you if they want to learn more, if they want to work with you, maybe get a policy. I don't have a affiliate link, but maybe they could just tell them, yeah, I heard from all over it podcast. All of us and me.
So you can reach out to us. You can go to the website www.vanguardofwealth.com, and you can reach both myself and my wife at that
So
website. You'll see our
like you
information at the
said,
bottom of www.vanguardofwealth.com, and
Vanguard of Wealth.
you'll scroll to the bottom. You'll see our information, and you can reach out to us either through email or phone number, and
Sounds
we'll
good.
get
Sounds
back to
good. Well, that sounds straightforward enough for anybody watching. As you can see, Vanguard of Wealth, VANGUARD of, I think it was spelled of, Wealth, WEALTH.com. Yeah. And you could find Clem and Shenita, and anything you want to learn, or if you want to advance yourself in financial literacy and life insurance and just generational wealth and securing your assets in your future, you could go to Vanguard of Wealth and reach out to them. And as they say, they are fully open to spreading the wealth, spreading the knowledge, and helping our communities, our circles grow and find ways to really maximize and leverage the tools that we have at our fingertips. It's not even far away.
Yeah.
It's right there. It's available. It's just for us to really see it, recognize it, and take advantage. So once again, I have to thank you both very much. Really,
Thank you.
really insightful, really inspirational. I think we really send the people on an emotional roller coaster today.
Well,
Ups and
good.
downs.
Good. I want them to
Yeah.
check into what they have,
Mhm.
Oliver. Don't wait.
Yes.
Check into what
Me
you
too. Me
have.
too. Me too. I agree, and really a reality check, because some people might feel like, man, I can wait till next week, I can wait till tomorrow, but you don't know what can happen tomorrow. And not to say it in a way to scare nobody, but just to be real, just the reality of life.
Yes.
It's what we live, what we experience. So
The unfortunate thing is, most of the time we don't move, we don't act until it hurts enough.
yep,
It could even
yep,
hurt, but if it doesn't hurt enough, we won't move. And that's the
yep.
unfortunate thing.
That's so true, especially in my community. That's how it is. People will be in pain months, years, they ain't saying nothing until they can't move. Then it's when they're gonna say, okay, maybe I gotta go check this out. And by that time, it's really a problem.
Hmm.
It's probably unfixable. So
Mm.
try to be mindful. Try to look at this as a like a advice, or think of it like a sign. Inspiration for you to say, you know what, maybe I should look into this. Maybe I should be mindful of my health and see what going on my side of things, even though I might be in my 20s, even though I might not be in my senior years. I still could have coverage, and it could even provide a wealth avenue for me too. So I feel like that's a win-win. Like I say, like Clem and Shenita say, you could get something for cheap. It depends on your situation, but it don't have to be something that can break the bank. So it's up to you now to do your due diligence, to check, see what's available to you in your situation, and yeah, take it from there. So like I say, thank you guys very much
Thank
Thank you.
you.
Thank
for gracing us with your presence, and for sharing this immense wealth of knowledge and insights and inspiration. I really hope this was an inspiration for somebody,
you.
and I do expect that you'll hear people reaching out, say, hey, that was a great, and hey, I want to learn about. So on that note, I want to thank my viewers. Yeah, I went over 9, so bear with me, but at least you're still here with me, so that's positive. And yeah, so thank you all for joining. Once again, I appreciate you. Without you, the viewers, there's no podcast. I'll just be here talking to myself. But yeah, once again, thank you. Another episode of All Over It podcast. Today was episode 22, where we spoke about life insurance, the truths about life insurance. We burst in myths, and yeah, we just cover everything life insurance. So catch me here next week, where I'll wrap up, do a debrief, a real close off to the financial literacy series, which last episode I did do a short recap, but next episode will be a real full debrief. We will really close off this chapter, move on to the next one. So thank you all. Love and blessings. Clem and Shenita, thank you.
Thank
I'll
You.
have you. And like I said to my viewers, thank you as well once again. And catch you here next week for another episode.